All right, George Tsilis joins us. Let's talk, George, about Powell here. To Kevin's point, I've given him some grief over the years when he gives me the young grasshopper stuff, but it is moments like this where I really like that perspective because he's seen a lot. You've seen a lot too. You're a macro guy, but a trader as well. When you look at this, do you feel that potentially the short-term Powell event could give us a better tone on the broader macro? Do you think he has that power at this juncture?
I think so. I mean, if you just look at how everything's sort of lining up, just starting from a technical standpoint, we're getting close to that 5150 area on the S&P and the NASDAQ also. These are levels that go back to summer of last year, so August of last year. And there's a major trend line that is established on the weekly on both of those indices. And we're close to those pivot points. I think, looking at the volatility structure right now too, obviously there's massive backwardation in the VIX futures. I'm looking for some convexity there. I like the Bitcoin angle as well because Bitcoin also has been leading this market down. If you want to use that as sort of a leading proxy for what's happening. I think at the high level, we were already moving into a fragile environment, irrespective of tariffs, moving from very exorbitant fiscal policy with high interest rates, because those high interest rates effectively created a massive windfall of the private sector because of interest paid on treasuries. Now that's coming down. That was coming down naturally, and we have to offset that by loosening monetary policy. So we were already at this inflection point. This is just going into the end of last year, beginning of this year. So then you add in this other policy aspect, the tariff aspect, and that's really disrupting this natural equilibrium that was really happening. I suggested we would already see some weakness in the markets, irrespective of tariffs, just because of this policy pivot. Now it comes down to questions of, is the Fed or Powell going to instill, fear? In other words, is he going to bring a little bit more concern than the markets are willing to accept at this point in time? They already adjusted from a summary of economics projection down their growth rates. And I think that's because there's already going to be a natural fiscal contraction because of lower interest rates. But, going forward, and I suggested this as well, just going back months ago, I think we'll eventually see an emergency rate cut at some point in time this year. I'm not saying it's going to happen now, but that's certainly a possibility we have to consider. So in essence, I think that he can provide support. I think everything's lining up, assuming we hit some of these lower levels, throughout this today, because we're seeing additional weakness right now. So we're not over yet. It's not over yet, but things are lining up for potentially a stronger close. That's what I'm trying to say.
I'm hearing it. I'm hearing you say it. I'm liking it. It's going to be tough. Bears taking a big swipe again here. Futures 52.39. We're less than 30 points above the lows, so we're giving back a good bit of that bounce from the early morning. But I do definitely sympathize with the notion of faster cuts than had been priced in. It's just, why not? There's too many, as much as I'm not like an inflation truther, there's too much validity to the point about the trailing impact of housing on inflation that's probably disguising a lower number than it is really in inflation. There's too clear of an argument that even though it can be debated that, we are too tight and we were too tight for too long, even though it was never been my core view, the points are strong enough that when you add on what's happening here with a big correction in equity markets, a massive panic in all macro assets, that Powell, I think, cannot be as soft in his tone today. I think he does need to say something strong.
I agree. And here's the thing. If you just go back and look at the end of last year, there was a divergence occurring between two-year Treasury yields and federal funds. The two-year Treasury yield indicated that the Fed was behind on the rate cuts by at least 25 basis points. This goes back to Q4 of last year. Now they're about 50 basis points at the very least behind the curve. So again, they're behind the two-year Treasury yield. They have flexibility to lower rates. Question is do they do it? Does that create fear or does that create relief? And, I suggest that they're probably going to do something either, directly or indirectly through language, because they've even said it, going back to the last policy meeting, that, their policies on quantitative tightening are now being reduced. And they effectively even talked about how, if they hit the zero bound, they'll reinitiate quantitative easing. So they're already giving us indications that they're going to support the market. So, but at some point in time, in the near term, we have to see a policy shift, either some amelioration in tariff policy, because I suggest that's a huge policy error. That's quite obvious the way the markets are reacting. But at the same time, we need some policy relief somewhere, whether it's either fiscal relief, debt ceiling relief, or Fed relief. This market is going to rebound strongly on any relief. That's what I'm trying to say.
Okay. Yeah, I think it's a very fair, good analysis. Unfortunately, the market might disagree. It's kind of pushing, well, not on the potential risks, but potential for strength to try and extend. Bitcoin pulled back as well. Pretty fast twitch movement there from crypto right now, giving us the kind of red light, green light for risk assets generally. So as stocks pulled back, so did coins there. Thanks for that. GT, we're also going to talk some Meta. I know you got some thoughts on that too, because we're going to trade with Dan Deming. What's going on?
Well, I mean, if you look across the board, there's obviously some discounts occurring in strong names like Meta Platforms. TD Cowen adjusts their target down slightly to 725 from 785. And I think right now there's a lot of compelling valuations to be said. If you look at even this year's forward multiple around 20 times, next year 18 times for Meta Platforms, it's down about 20% in the last 30 days. But these are, again, some of the mega cap names you have to consider that are going to be more immune to challenges like tariffs because they're digital assets and digital revenues. 60% of sales for Meta Platforms are overseas. So you have to be mindful of that. But I think the estimates have come down slightly, but they do maintain basically an outperform rating on the name going into the end of the year, just because of sensitivity that companies are going to have to cutting CapEx, maybe even cutting back hiring or laying off people, just based on the negative sentiment we're seeing in the economy and the markets right now.
Yeah. Meta, oof, boy, yeah. I mean, you would think a fairly tariff, removed business, but that kind of logic gets you in trouble lately. Thanks, George. Appreciate that. Nice chat there on the potential for Powell to firm this market up. It needs firming. Dan Deming joining us for a trade, managing partner at KKM Financial. Dan, Meta's getting clobbered. It doesn't seem like a business that really should be subject to like tariff concerns, but obviously the market is not taking a scalpel, it's taking a sledgehammer right now.
Yes, exactly, Oliver. Yeah, it's pretty much across the board. And the one thing about today that's different than yesterday is the defensive names are getting knocked down today. I mean, you're looking at utilities under significant pressure, healthcare now selling off, and some of the names that held in there yesterday are also getting dragged down today. So hopefully, historically, this is what would be considered a capitulation day. But at the same time, I think some of the variables involved this time around, it's very difficult to discern that at this point. Yeah, the one thing that's significantly different from yesterday to today is that you are seeing really the entire market under some significant pressure. You pointed out a couple of outliers there, Oliver, but it's really more about those defensive names that held up reasonably well yesterday are now also getting dragged down. So, I mean, we'll see what Powell offers. It does appear that, there's still potentially more fallout from other retaliatory tariff announcements, and ideally something will get done before next week as far as cooler heads will prevail. But right now, the market is very shook up, and rightly so, I think, given the fact that some of these announced tariffs were much larger than what the market had anticipated.
Okay. Totally. I mean, the average or the median was like 28%, I think.
Right.
And
you and I talked
then,
about that just a couple of days. Yeah,
exactly.
Right before the announcement.
And our thought was 25. We've heard all about worst case scenario, and it wasn't. There was a worse scenario. So,
exactly.
But the logic basically held that if we went above that, okay. What do you see in the trade and the options for stuff like Meta right now?
Well, you're seeing, as George pointed out, very high implied volatilities now, and again, because of the significant volatility. So there are opportunities here when you do see implied vols get to these levels. So the trade example today for Meta is buying a put 1x2 in May, and I'm looking at the 500, 450 put 1 by 2. You can buy that 500 put, sell 2 450 puts for even money right now, somewhere close to even money. Again, the break even on this is 400. Okay, so the idea is that if we do see further downside, it might be a little painful on the way down, but if we still hold above 450, then this trade's going to really expand. And if we again hold these levels, that 500 put's probably going to hold up relative to the 450 put. And the idea here though is if we trade below 450. You're okay getting long the stock below that level. So really the break even on this is 400. So effectively you're picking up the stock at 400. That's a level going back to February last year. Again, that's 100 points below where we're currently trading, or by basically 20%. And, I think at those levels, if we do get there, that's a place where you probably would consider picking up some Meta.
All right, yeah. I'm into it. You got to be ready. You got to be ready. Because this is the market where if you love it at 511, if you like it at 511, you're going to really love it at 450, and we might just test your love sooner than you prefer.
It might. But yeah, the idea here, Oliver, is try to not put out any kind of cash outlay on this thing. Again, because of the high implied vols, you're going to pay a lot for any kind of option that you might buy. So again, the volatility is supporting that right now, but once the volatility comes in, those options are going to decay very rapidly. So I know this is playing for a range to the downside, giving yourself a big range because you can because of the high implied volatilities. It offers a big range right now. And normally you don't get that type of range as far as break evens, but in this case you get a break even at 401 basically on this trade example. So I guess if you're okay with that break even point on Meta, then this is a way to capture maybe some further downside and then have the opportunity to get long at a much better level.
All right. Like the trade, makes sense to me. If you're feeling that this is a business that's going to be able to get back on its feet when it hasn't fallen off the stock price has. So yeah, all right. Appreciate it. Thanks, Dan.
You got it, Oliver.
Good stuff. 510 for Meta right now. Sell the 450 put and be ready to scoop it up if it gets there. Thanks, Dan.